Hey, Saretsky here. Welcome back to the show. Currently in Vegas, but here for a friend's wedding. As you guys know, wherever we go, we never miss a show. So I'm here putting this video together because I think there's some pretty interesting developments that have been happening this past week and really kind of highlights the bigger picture thesis that we've been talking about on this channel for really the last month or two now, which is, listen, the data in the US is just not deteriorating as a lot of these market pundits had expected. And so this is starting to price out Fed rate cuts. And if you're the Bank of Canada, it just gets really hard to cut rates in any meaningful capacity if your counterparts over in the South are not cutting rates, right? I mean, you end up depreciating the Canadian dollar and then basically importing inflation. So you really are kind of somewhat at the mercy of the Fed. And so we always have to say, okay, what's happening in Canada? You have to look at the US. And so there was a couple interesting data points out of the US this week, which was, US CPI, headline inflation, core inflation coming in hotter than expected. And this is kind of just this recurring theme, right? Inflation coming in higher than expected. Ultimately inflation, on a headline basis based last summer. And since then, the last mile, the last tick on inflation uh, is nowhere to be seen. I mean, we just haven't been able to get it down into that range for the Fed to start cutting rates. And so you can then see it in a data point later this week, US PPI, producer price index. Again, we talked about it on the Loonie Hour, but producers are starting to pay higher prices. Of course, that starts feeding through into goods that people consume. So long story short, is if you look at the data that's coming out of the US, it continues to be resilient enough, anyways, that there's really not a lot of air cover for the Fed to actually begin cutting rates. And so this is kind of the worst case scenario if you're the Bank of Canada or if you're an over levered consumer here in Canada, right? Because I think the reality is everybody in Canada that has some debt is looking for lower interest rates, and so um, the US is really keeping that at bay from getting the rate cuts that we have here. So all you have to do is look at the Canada 5-year bond yield. Of course, that's what prices, your 5-year fixed rate mortgage. And so you can see bond yields are pushing back higher again after the latest data point, up something like 15 plus basis points this week. So it's a big move that you'll probably start to see the banks maybe potentially beginning next week start to push rates back up. So just on our quick channel check from the mortgage front, we're seeing rates again. You got to make some calls. You got to work the phones. We're seeing rates right now as low as 3-year fixed 4.99 uninsured mortgage. That's what we're seeing in our channel check. So that's a pretty good rate, but I expect that to be moving higher. Expect those discounts to come off, assuming the bond market continues its current trajectory, which is, hey, we're starting to discount the realistic possibilities of a rate cut. And so this kind of leads again into the bigger picture, which is, okay, so let's talk about it, right? The expectation coming into this year was, hey, rate cuts are coming. How many are we going to get? Just a matter of how many. And now they're just being pushed further and further out. And so, if you're the Canadian housing sector, where basically 50% of the mortgage renewal book still hasn't seen a mortgage payment increase, right? All these people that are still on fixed rates at 2.5%, 2.8% are going to be coming up for renewal here later in 24, 25, and 26. And we can actually see the largest renewal period in Canada is actually in 2025 and 2026. And so the longer that rates stay higher, I think the more issues that we're going to have, right? I mean, you think about the typical person that comes up for a mortgage renewal is their renewal comes up today and they are paying 2.5%. Well, now they're paying 5%. So they'll do a 3-year fixed rate mortgage. Well, it's like, so, you might see someone's payment increase by, let's say, $1,000 a month. Well, it's like that $1,000 a month just slowly chips away at disposable income that ultimately could be spent elsewhere in the economy. So a lot more funds just going into servicing debt, which is a net drag on overall GDP growth. And this is just obviously a concerning scenario for a Canadian economy that has really seen, GDP per capita it has basically gone nowhere in the last 7-8 years, and so this is going to continue to slow the economy moving forward. But also brings me again to the mortgage renewal wall. You can kind of see, we've got some data here from Wawa that they put it out this week, showing each bank's mortgage renewal wall, so to speak, and the largest one being CIBC. So between February 2025, which is next year, and February of 2026, you can see as much as 28% of their mortgage book is coming up for renewal. And so really it's like the question is like, well, what are rates going to be in February of 2025? I mean, if they're anywhere close to the levels that we are at today, that is again going to be problematic. So the Bank of Canada is very, very well aware of this data, guys. They're obviously hell bent on trying to get rates down, but they are again at the mercy of the market, of the data, and particularly of the Fed. I remember when Tiff Macklem had his rate hiking cycle, one of the things that he kept emphasizing, right, is like, listen, we're going hard, we're going fast, we're going quick right now on the pace of rate hikes because we want to be able to get them down quicker. We know how levered the Canadian housing sector is, the consumer, and the consumer is, 65% of GDP. So we need to get rates down ASAP. And again, looking at the US data, that continues not to be the case. So I think just what I would encourage people is there's going to be a lot more volatility in rates markets. It's been the core thesis of this channel for the last year and a half. I continue to believe that. I think if you've got rate holds today, you should definitely be going out, picking up the phone, securing those rate holds, whether you're coming up for a renewal or whether you're in the market to purchase a new property. The key theme should be go in, lock in today, because in 6 weeks, you could be looking at 3-year fixed rates back at, in the mid fives if the bond market continues in this direction. And so, it would be interesting to sort of see, some of the discussion is around like, wow, like, the economy's been kind of resilient, right? I mean, all these rate hikes, like no real recession yet, no real crisis. Like, what is going on? Well, I think, a report from RBC really highlighted that this week, which was we just pumped so much money into the economy during the pandemic. The fiscal taps from, whether it was the Canadian government, JT, or it was Joe Biden in the States, the fiscal taps were just completely unleashed. And so we have data coming out here showing that, whether you're a renter or you're a homeowner, your net wealth in Canada grew exponentially during the pandemic. So, both homeowners and renters experienced exceptional wealth accumulation from pre-pandemic levels up to Q2 of 2023, with net worth up 34% for homeowners and 23% for renters with no real estate assets. So renters that had no real estate assets, even their net worth went up by 23% during the pandemic. And again, a lot of that was from the fiscal largesse. And so there's still a lot of that savings, that wealth that they've accumulated during the pandemic that has not been unwound yet. And so we're now starting to see some of that savings that is starting to happen. So Canadian renters, for example, as a group, are feeling the largest burden of this rate hiking cycle, actually, ironically enough, where they're spending more than they're earning each quarter. So right now, collectively, renters are spending 9% more than they earned in household disposable income in 2023, while homeowners saved 7% of their take-home pay. So you can see at least the renter pool is dissaving. I think there's still obviously this massive, massive gap in Canada between homeowners and renters. A great chart again here from RBC showing the discrepancy between Canadian homeowners, their net worth being 4 times higher than renters here in this country. And so I think that's why you're continuing to see, this social divide. It's crazy to think that I think it was the Ontario Landlord Board, Landlord Tenancy Branch, has something like 50,000 disputes in the queue. There's this massive backlog, which is basically tenants have figured out that they've essentially been screwed or left behind during this rampant real estate asset inflation bubble, and basically are falling further and further behind and are starting to game the system, which is like go rent a place, pay rent for the first 2 or 3 months, and then just stop paying. And and basically it'll take a year or more to get kicked out of the property because it takes that long for the Ontario tenancy branch to actually process these evictions. And so you basically end up just living in a rental property for free for a year. And I think this is really highlights the growing societal frictions in this country. And so, again, I'm just looking at the big picture. I don't think it's this rosy outcome. I think that the worst case scenario for the over indebtedness of Canadian households is having rates higher for longer. And again, I think that's being driven by the Fed in the States. The US economy continues to kind of hold up. I think the economy in Canada is faring a lot worse, but it's just hard to cut rates when, again, your neighbors to the south are holding up as well as they are. And so a lot of these homeowners that are coming up for renewal are going to get stuck with a bill. And I think there's going to be, I look around and you see these tent cities and all these major metropolitan cities in Canada, and you scratch your head and you wonder, is it going to get materially better over the next 12 to 24 months? I mean, if we look at, the National Bank housing affordability metrics, they're at all-time highs. They're at all-time worst levels of affordability that we've seen in decades, and that's the picture. So again, hope that helped as always, and we'll see you next week.